The underlying fundamentals in this current marketplace look eerily similar in some ways to 2008. And we're talking about the housing market. And we're talking about specifically cash out refinances. And some of the latest trends we're seeing, borrowers are possibly going back into this concept of using their home like an ATM all over again. And today we're going to discuss what are the statistics about it saying about how it'll affect the future value of real estate. Let's get into it. So Housing Wire just came out with an article that says underlying fundamentals are significantly different than what we saw in the early 2000s. But they're hearing a lot of chatter about the boom in cash out refinances. And the presumption seems to be that it's destined to wreak havoc on the housing market and the economy at some point. Yeah, so Freddie Mac just put out a bit of data that Housing Wire reported on. And obviously towards the end of 2020, people are borrowing a lot of equity out of their homes. Now, this is still not where it was at the peak. I mean, obviously you can see in the same graph that this raging area right here throughout the middle, throughout 2006, 2007, there was multiple more amount of money taken. I mean, talking like 50 billion on one, and from our last quarter and in 2007, you can see by the graph, this is over 100 billion in a single quarter. So you have double the quarterly cash out refinance, people taking cash out of their house. The reason why this is troubling is because the more money borrowed, it creates a couple different effects. Number one, it creates an increased payment, okay? And number two, it creates a loss of equity. So you're reversing equity. You're basically borrowing against value. You're taking out more money out of the home itself. And then conceivably, if there is trouble, you're kind of creating two factors that are dangerous at the same time. You're increasing the value, what the home is, what's owed against the house that has to be paid off in sale. If there is duress or some issue, you have to sell the house. But then you've also got the situation where the payment is jumped. So, one might say, this is dangerous. This is a sign of issues, of things to come. Would you agree with that?
Yeah. Well, I would say that the overall context of last year is definitely important to take into. I mean, if there was a year to take out money out in an emergency, it was 2020, right? A lot of people lost their jobs. A lot of people had to move. A lot of people, it became just a primary issue to pull out money to make the home nicer, because now a lot of people had to work from home. When people needed money, they looked to their home. They cashed out 80% of the value, which is actually, that's all the cash out refinances will let you go up to. They won't let you cash out refinance 100% of the value. They'll go up to 80% because they're banks, they're money, they're experts at money, right? So it's all being done safely, and I think taking into context the COVID market, I think it just makes sense. Something to note here is that people are sitting on a lot more equity than they were at the bubble. During the bubble, at the peak of it, they were at $4.6 trillion in total equity in the market. Total equity, right? The whole market had that much money. It didn't even reach 5. Right now, in our market, we're sitting at $7.3 trillion in cash outable equity, if that makes sense, right? So we are sitting on a lot more money. So seeing a small bump in the overall scheme of things, we're actually in a pretty safe. I mean, if there is going to be a crash, I wouldn't see why, since homes really aren't overpriced. We're not seeing the mortgage fraud that we saw. And this are going to go back and forth, but I mean, we're not seeing people qualify for homes that they're not actually qualified to own, right? And qualifying for payments from banks that they should never have had, just like it happened just a decade ago, right?
Well, so here's the thing. It's fine to say that lending is more stringent than it was before. That is true.
Big time.
So easy lending allow people to really kind of use the home as an ATM, if you will. But here's the thing. One thing that is a concern is the home values are in a runaway train kind of thing right now. Like, you have home values escalating beyond belief. So for instance, if you have some of these housing graphs, for instance, like you could look at anywhere in the United States, you could look at the Central Florida housing market over the last 5 months. It's like SpaceX, Elon Musk and the rocket going straight up.
Yeah.
Like it's vertical. You look at Canada, it's vertical. You look at other countries, the housing markets are vertical.
Yeah.
So what happens is what goes up seemingly must return to planet Earth. If you are now lending on loans that are, you're creating new math, even if it's 80%, if your value jumps so fast, so you have 10, 15. I mean, like I looked at some numbers with just Lake and Orange County, and you had like, $60,000 price increase across an average section of homes. So you had like a 20% jump. It's like 330 to like 390 across 2 counties I'm looking at. Okay, so that will immediately, like according to lender numbers, they're going to pull an appraisal. If last year it would have appraised at 330, this year appraised at 390. What my point is, you're now taking and you're creating a loan at a percentage of a value, a target value, that are like red hot. So that does create more of a risky loan. Okay. Now, yes, we are more conservative on the mathematical equations of how we're getting to give people money. That is true. Okay, I do not disagree with that. But I am saying that like things are changing so fast. Here's the challenge too. Think about how fast these ratios are climbing. Okay, so you have math going up on what a house is worth, math going up on what you can get lended on it because the amount is higher. But that number is getting moved much faster than the actual rate of wages. So living wages are like this, and then prices are going up and borrowing is going up. That's not a good thing, because what that says is, interest rates are down, so it does create a lower payment against the debt you're borrowing and all that kind of stuff. But you are still increasing your payment. You're going to borrow some money out. People took $50 billion out last quarter. That now means they all have higher payments. Now, if they were borrowing because they were in trouble, or maybe there's a lot of people that were just adding on an office for themselves, a dance studio, a fitness center, or whatever.
They move their parents in. They got to make the house more accessible for their parents. Makes sense. What I would like to compare, and just to kind of balance things out here, is just to show you some raw data, and we can pull this up on the screen. From 1985 to 2000. The percent of the median income needed to purchase a median price home, right? So that the average buyer making the average income on an average home, the price of the mortgage of the home was 21.2%. During the bubble, it was 25.4%. Right now, in today's market, we're at 14.9%. People are very comfortable with the mortgage payments. Interest rates are low. Homes are still on the incline because we're in a recovery from the crash. So we're making up for lost time. Right now, the fact of the matter is we're actually qualifying people for homes that they're very, very comfortable paying right now. And I don't see any trouble here when we're comparing this to the market or even the actual historical norm from all data collected. We're at 14.9% of the median income goes towards somebody's mortgage. That's pretty comfortable to me if you think about it. That's 1 in 7. That's 1/7 of the median income going towards somebody's mortgage. I mean, people are wanting to qualify for more. I mean, bigger homes are more popular now. People are not just living at home now. Now they're working from home. They're starting their own businesses from home because they're seeing that a lot of businesses failed, but now a record-breaking amount of businesses have opened because of that. This is an incredible comeback that we're seeing, and people are using their homes in different ways, and it's just incredible to see how America's bouncing back. So
listen to this. So I was actually doing some research on the topic of cash out refinances, and actually it's not easy to find a lot of data on exactly how much of this is turning over recently. But there is a guy named 𝐤𝐡𝐚𝐭'𝐬 who is he's a Wharton finance professor, so Wharton Business School, and I believe he's out of University of Pennsylvania. And his co-author, they wrote a paper. They did a ton of research on refinances going into housing crashes, say recessions. And what he said, let me read the article from Wharton UPenn. He said, he starts off by talking about how times past, people started using their home as an ATM. He said, that's what happened a decade ago when the housing market collapsed. New research from the same guy, Wharton finance professor 𝐤𝐚𝐭'𝐬, shows that the pattern wasn't particular to that one recession in 2008. He says, looking back 30 years, Rusanov and his co-authors found a cyclical pattern of refinancing before each recessionary period. Now, if that is true, right, and you stare at this graph, okay, let's all stare at the graph. Right? Where's the last recessionary pattern? So you have, you had a blip at the end of the dot-com bust here going into 2000, but then going into 2007, 2008, it just never stopped. And I mean, as you can see, in the early 2000s, you had a trend, according to Freddie Mac, of cash out refinances just taking off early. Now, it took, from 2002 to it took 6 years of people piggy banking the house, cash out, ATM, taking tons of equity out before anything happened. Okay, yeah. So you got to look at this. There's no question that in the last year, the climb has gotten much steeper. The volume of cash coming out has gotten much higher than it has at any point in the past 10 years since that time. Okay, we're at record levels post Great Recession. Okay, that's true. But at the same time, if you look at this, there were steep climbs, then there was some more descents, and then there was more money. Okay, yeah. So with all that being said, recession may not be around the corner. Like it may be, we might be at the start of 5 or 6 years it takes to actually formulate a bubble if it mimics last time. Because clearly, in the early 2000s, the market was, felt the same, super hot, a lot of action going on, a lot of appreciating, a lot of, the same experiment we're seeing in the marketplace right now. Similarities. However, it did not disrupt overnight. Did not fall after the cash out started.
Yeah. There was a lot of fraud, and I mean, I think the last crash had everything to do with real estate. So I mean, it's tough to kind of make a one-to-one draw because people were they had adjustable rate mortgages. They were qualifying for 2, 3, 4 mortgages. You could write a mortgage up for somebody's dog. It was nuts. It was the wild, wild west of mortgage lending. And so, I mean, it's tough to say because the market was going so crazy up. I mean, the market was not, even the market appreciation was not as high, was higher than when we're seeing now. So if we look at the numbers, in 2002, the annual home appreciation of prices went up 8.5%. 2003, it was 8.7. 2004, it was 12.5. 2005, the market went up 11.4%. These are insane numbers. Right now, we're seeing in 2017, it went up 6.4. 2018, 4.8. 2019, 4.7. Last year, it was a big market. It went up 9.2%. Right. So I mean, we're not seeing the level of appreciation that we did back during the bubble. And also, like we were talking about, mortgage lending standards are much higher. I can pull up this graph too. It shows the actual. It's from the Urban Institute. It shows the amount of risk that the lender takes, that a product it actually has. In terms of offering it to the buyer, in terms of lending standards, is it below or above reasonable lending standards? Is it very hard to get a mortgage or is it very easy? And it shows that number is actually going down right now. It's actually getting harder to qualify for a mortgage just based off of lending standards because, I mean, it just makes sense. The home prices are going up and the bank's going to want to protect their investment. They don't want a bubble crash like the last time, if that makes sense. So it's harder to get a mortgage. I think we're in a much stronger market than we were then, and we'll pull these graphs up so you folks have access to them as well.
And